high energy prices, high fuel prices, some turmoil in financial markets, all of this causes investor uncertainty. And if there's one thing that's bad for cross-border investment flows, it's investor uncertainty.
Hello, this is the Weekly Tradecast, a podcast brought to you by UNCTAD, the UN's trade and development body. I'm Sarah Toms. We're exploring how major events are shaping trade and development and how that affects billions of people around the world. This week, we're looking at the UN's latest World Investment Report and the key issues around development, clean energy, and sustainability goals. Last year, global flows of foreign direct investment, or FDI for short, fell 12% after nosediving in 2020 and recovering in 2021. Developing countries did better than most as their FDI flows grew in 2022. But the heavy pressures on all economies remain, from the war in Ukraine, high food and energy prices, financial turmoil and debt difficulties. Given the challenges, UNCTAD expects investment flows to continue on a downward path this year. Warning of a massive gap in funding that threatens the Sustainable Development Goals, the report calls for greater investment in clean energy to meet the goals and ensure developing countries do not get left behind. Well, joining us now to talk about the FDI trends and the imperatives for a sustainable energy future is UNCTAD's Richard Bolwijn, who leads the research on the annual World Investment Reports. And before working at UNCTAD, he advised many private sector firms on international investment. Well, thank you for joining us today, Richard. Now, to start off, give us an overview of the investment report. What are the main themes, challenges, and hopefully the opportunities?
You mentioned already trends in 2022 were not that positive. Global flows were down 12%. But there were some bright spots. Developing countries had an increase of 4% of foreign direct investment. And while project finance values were down and mergers and acquisitions were down, greenfield investment project announcements were up. So these are announcements that companies make to make new investments. So they say something about where foreign direct investment will go in the future. So there's some bright spots there and good growth in developing countries of greenfield investment project announcements. This helps. We have growth in so-called GVC industries, global value chain intensive industries such as automotive, electronics, chemicals. These were up. Of course, global supply chains have had a difficult time in the last few years. And the hope is that through new investment and more diversified investment and more diversified locations, developing countries can access global value chains and use that for their development in the coming years. So the increase in greenfield projects in those industries has been particularly positive.
Why are we seeing such a downward trend, though? Is this still because of post-COVID, we're still recovering, or is it to do more with the energy prices and the food prices?
I think many different factors have affected this. High energy prices, high fuel prices, some turmoil in financial markets, all of this causes investor uncertainty. And if there's one thing that's bad for cross-border investment flows, it's investor uncertainty. They will rather wait a little bit before committing to large new investments overseas. So all of that affects investment negatively. But in the meantime, plans go on, right? Foreign direct investment has a long gestation periods, right? So companies plan well in advance. And that's why we still see announcements of planned future investments in the future. But the actual flows last year slowed down a little bit.
So how do we move towards recovery with so many challenges in the way?
There is going to be downward pressure on FDI this year, for sure. If we look at the data for the first quarter of this year, some early indicators, they show, again, mergers and acquisitions on a downward trend. They show project finance values significantly down. And we've just had recently big turmoil in the banking world. Financial markets are not doing that well. So it's logical that you get that effect. But as I said, greenfield projects and actual projects on the ground may not be doing that badly. So on the contrary, in developing countries, they need a lot of new factories to be created, new productive capacity to be created. So they depend more on that. While the global flows, yes, there will be downward pressure in 2023, but it may not be as negative as we think in the developing world. Well, looking at the bright spots last year, one of the biggest ones was a huge increase in inflows in Latin America. There's been a big increase in foreign direct investment in Latin America, but a lot of that is, of course, driven by commodities. Other bright spots, Southeast Asia, South Asia see an increase. Southeast Asia has been an engine of FDI growth for a very long time already now. So a lot of the foreign direct investment there is driven by regional economic cooperation and integration between markets, investment in special economic zones, industry, export driven.
Now, the report says we need staggering sums of extra investment, $30 trillion, if we hope to meet the Sustainable Development Goals by 2030. Where is this money going to come from, and how would it be best spent?
Now, two things happened. One, we've had continued underinvestment, so automatically the gap increases. And two, we've had a series of global crises. And of course, those global crises, especially health and energy, they've caused an increase in investment needs. So we're now estimating to be up at above 4 trillion per year of annual investment gap. And where's that money going to come from? It can be filled with public investment, governments. It can be filled with private investment. And the private investment can be domestic, it can be international being FDI. Now, the sums are so large, it cannot all be public investment. And especially in the developing countries, the local resources are simply too scarce, that there have to be external sources of finance, where FDI is one of the most important ones. There are a number of sectors that are very attractive for international private investors. Renewable energy, infrastructure can be attractive. There are other sectors that have much more of a public service responsibility, where it is much more likely that public sector funding will have to do the job. Health and education, obviously, are sectors that will not receive a lot of foreign direct investment.
Why is energy so important to achieving these development goals? And what's the most pressing issues around energy investment and sustainability?
The need for investment in energy is enormous. It's the biggest component of the investment needs in the overall SDGs. And that is because it touches on multiple Sustainable Development Goals and, of course, on the objectives of the Paris Accords, right? We're in the middle of the energy transition. So we need investment that supports the transition to green and clean energy. But we also need to still culminate a huge gap in terms of access to electricity in many developing countries. So it is not just about making the energy transition, it is also about providing energy for all. And in addition to that, with the recent energy crisis, a third objective is now at the fore in many countries, which is energy security. The investment needs extend well beyond the 2030 agenda and are enormous.
Developing countries are getting more FDI, but in the report it says that 30 of them do not have any international investment in energy transition projects. How can we shift those patterns and fill those gaps to keep all the countries on track towards cleaner energy and the development goals, not just the most promising countries?
Yes. You're absolutely right. If we look at international investment trends in renewable energy, and most of that comes in the form of project finance. The large utility-sized renewable energy, electricity generation assets come in the form of project finance involving multiple financiers. A lot of that is international. So if we look at worldwide, about 55% of those utility-sized investments are international project finance. And that number increases to about 70% for the least developed countries. And that means that the poorest countries are very dependent on international investors to grow their renewable energy asset base. That's a problem because these countries in general, beyond energy assets, have a problem or struggle to attract foreign direct investment. And they struggle to attract large project finance projects because they have very high risk ratings, right? Some of them are in debt distress. Right. They have risk ratings that are simply not attractive for foreign direct investments. That's why you see still 30 developing countries and about a dozen of the least developed countries that haven't yet attracted a single international project finance deal in renewable energy. Now, how do we change that? Well, there's several things. The main challenge really is a challenge of risk ratings and a challenge of cost of capital. The fact that developing countries have such high costs of capital really is a disincentive for their transition to clean energy. Right. If we look at the projects that do exist in developing countries, on average, bringing in an international investor brings the cost of debt, the spread on debt financing, down by about 8%. If you bring in multilateral banks, it brings it down to about 10%. If you combine international investors, multilateral development banks, and government involvement through what's called public-private partnerships, you can bring the cost down 40%. So that is the answer. So what do we have to do to make sure that developing countries, and especially the poorest countries, can access international finance for renewable energy? It is creating those public-private partnerships with the involvement of banks, with the involvement of international investors. Now, that shows how important it is to promote solid public-private partnerships and how important the already planned and ongoing shift by development finance institutions to financing much more of the energy transition, how important that is. So that's a really good step that is being taken right now.
Okay, well, thank you so much for that, Richard, and explaining the themes. That was Richard Bolwijn, who was this week's guest. Tune in to the Weekly Tradecast next week and every week for more insights on the most pressing issues around the world of trade and development. There's even more on our website, UNCTAD.org. I'm Sarah Toms in Geneva. Goodbye for now.